Most brokers spend their whole first year obsessing over new leads, new content, new introducers, new inquiries, new calls, new absolutely everything. And meanwhile, the single biggest income stream in a mortgage broker's business is quietly walking out of the door because they haven't set anything up to catch it. That income stream is remortgages. And the difference between the broker who builds a proper remortgage book from day one and the broker who doesn't is genuinely the difference between a career that pays for a decade and one that stalls at year 3. This isn't a marginal point, okay? Remortgages are the single most undervalued income stream in this industry, and the one that nobody talks about publicly because it's boring, it's unglamorous, and takes years to compound. But if you understand it from the very start, everything else about this career completely changes. Now, here is why this matters so much. Every mortgage that you place today comes back to that client in 2 to 5 years when their fixed rate ends. That's a fact. It's not an opinion. It's how the UK mortgages work, which means every client that you have this year is a client who needs a mortgage somewhere between 2028 and 2031. The question is whether they come back to you or to somebody else. You see, most brokers assume the client will just come back because the service was good, but that is super naive. 2 years is a long time in a client's life. They forget your name, they forget your face, they forget which broker they used because they only spoke to you for about 6 weeks. And when their rate is ending, they Google best mortgage rates and click on the first advert that comes up because you didn't stay in touch. And nobody in this industry told them why they should. Every one of those clients is a case where you already earned once and you lost anyway. That's the cost of not building a remortgage system. And it's the reason most brokers still find themselves grinding for new leads in year 8, where they should have been sitting on a book that pays them without a single new inquiry. Brokers who build the book earn compounding income for decades. The ones who don't earn transactional income forever. Same lender panel, same case volume, wildly different careers if you look at the two. So let's do the math on this first because it's genuinely wild once you see it clearly. A remortgage pays essentially the same prop fee as a new purchase, usually between 0.3 to 0.4% of the loan. On a £250,000 remortgage, that's £750 to £1,000 back into the firm. If you charge a broker fee, that lands too. If you attach protection properly, that lands as well. Same money as a new client from an advertising campaign, except you didn't spend anything to acquire the client. They were already yours. Multiply that across a book of clients over years, and a broker with 50 clients placed in 1 year has 50 remortgage conversations rolling through in year 3. A broker in year 5 has hundreds of clients rolling through those remortgage windows every single year. And that's the entire pipeline of pre-warmed, pre-qualified, pre-known cases turning over annually before you've done any new marketing whatsoever. And here's the part that changes the shape of the whole career. Each of those remortgages takes a fraction of the time as a new purchase takes. Most of the documents are already on your CRM. You know the client, you know their circumstances. The trust is already built. So the effective hourly rate on remortgages is dramatically higher than the ones on new purchases. It's more money, it's faster from clients you already have. This is why year 5 in mortgage brokering careers looks so wildly different to year 1. It's the year where the remortgage book really starts firing at scale. Now, one thing every new broker gets confused about, the difference between product transfer and a full remortgage. See, a product transfer is where the client stays with the same lender but moves on to a new rate at the end of their fixed term. There's no new application, there's no new underwriting, no valuation, no legal work. It's faster, it's cheaper, it's easier, but it pays less proc fee. Typically around half of what a remortgage pays, somewhere between 0.15% to 0.25%, depending on the lender. Full remortgage is where the client moves to a new lender entirely. Full application, new underwriting, new valuation, new legal work, full proc fee, full broker fee if you charge one. Full protection review because their circumstances have changed. Here's where brokers get lazy though. Product transfers are quick money. You can do them in 20 minutes and bank a small prop fee on there. So new brokers over-rely on them because they feel like free income. The same client, if you looked properly at the whole market and found them a better deal with a different lender, would have paid you double and often given them a better outcome too. See, the rule is this: product transfer only when it genuinely is the best option for the client, not because it's quick, not because the lender's making it easy, and not because you're too busy to research properly. If the client's circumstances have changed or there's a better product that exists elsewhere, they deserve a full remortgage advice. And if the full remortgage is genuinely the better thing, you're paid twice as much for delivering a better outcome. So everybody wins. Now let's talk about the specific mechanic of when to talk to remortgage clients, because this decides whether you keep them or lose them. 6 months out from their fixed rate ending is when the conversation normally starts. Not 3, not 4, 6, because at 3 months out, the client's already stressed. They're Googling, they're getting bombarded by their existing lender trying to product transfer them, and they're seeing the rate change news on the TV. And at 6 months out though, none of that has started yet. You're the calm, prepared voice landing in their inbox before the panic has kicked in. That's a completely different conversation. The script is simple. Just a heads up, I've got you flagged up as coming to the end of your fixed deal at around insert the date. About 6 months out from that, I'd start looking at what's available so we're ready to move calmly rather than rushed. I'll be in touch with you close to the time to walk you through your options, and there's nothing you need to do right now. I just wanted to let you know I've got this in hand. That single email sent 6 months out does 3 things at once. It reminds your client you exist, it positions you as a proactive and organized person, and it kills any anxiety they may already be feeling about their rate ending. 9 times out of 10, that email alone secures the remortgage conversation because the client now assumes you're just handling it and they stop looking elsewhere. Quick pause here, because if you're watching this and you're thinking, actually, I'm already past this beginner stuff, and you want to know how top brokers in the country are running their businesses at scale, that's not what this channel is for. This channel is for people starting out, but I've got a second YouTube channel, which is Ash Borland, the Mortgage Business Mastery Show, where I put out a weekly video specifically for established brokers who want to build, scale, and get seriously good results. Sales, retentions, systems, hiring, the lot. Now, if you want to get a head start and see what this career actually leads to once you're properly running, the link is in the description, and also I will pin it in the comments too. Check it out when you get a minute. Please do, and also subscribe there. Anyway, let's get back into the episode. Now, the remortgage conversation is only half the equation. The other half is what you do in the 2 years between the original mortgage and the remortgage window. Because if you disappear for 22 months and then reappear just checking in on your rate, you are a stranger, and strangers don't get remortgage clients. Retention isn't complicated. It's 4 small things done consistently. A newsletter roughly once a month. Doesn't have to be elaborate. 2 to 3 genuinely useful things, a market update, a piece of general information around financial hygiene, maybe a client story. It's not sales content, okay? It's not book a call with me. It's actually useful. A completion gift as well, something personal, small and thoughtful, not branded tat, don't do that, not a hamper, something that shows you actually paid attention to who they are. That gift gets remembered for years. And an annual check-in if you can. 1 email once a year that isn't tied to their remortgage, just a how's the house, how's life, anything changed I should know about. Half of them won't reply. The ones who do though will tell you about a new baby, a pay rise, the second property they're thinking about buying, every single one of which is a case waiting to happen. And the 6-month remortgage nudge, we've already covered that. That's that one. That's all you need. 4 touch points a year. Genuinely low workload once it's all systemized. And it's the entire difference between a book that renews itself and a book that quietly leaks out over 5 years. Now, the obvious question is, if remortgages are so lucrative and retention is so easy, then why do most brokers not do it properly? Well, 2 reasons. First is retention is invisible. Can't see the return in real time. You send newsletters for 2 years before the compounding shows up on your bank statement. Most brokers can't hold that patience. They abandon retention before it pays them, and then they conclude it doesn't work. The second is retention is boring. It's not new. It's not exciting. It's not the case that just came in this week. It's the client from 18 months ago that you haven't thought about since. Brokers who love the buzz of new business often quietly deprioritize the clients who paid them last year because those clients feel done. But they aren't done at all. They're just early in a decade-long relationship. The brokers who thrive long-term are the ones who realize that boring, invisible work compounds faster than glamorous, visible work. The newsletter written on a Tuesday afternoon in year 1 is what pays for the summer holiday in year 5. It just takes years to see it clearly. Now, the mechanical foundation of all of this is knowing when every one of your clients is coming up for renewal, which means your CRM has to be set up properly from day 1. If you don't track your remortgage dates automatically, you don't have a remortgage book. You have a pile of past clients that you'll forget about. Every modern broker CRM system should be able to handle this. All of them out there, if they're good, they'll do it. They all track fixed rate end dates and can trigger reminders, and hopefully some of them can even do automated emails. Set it up once, it runs forever. 6 months before every climb rate ends, you get pinged automatically. You send that pre-written 6-month email, the conversation starts, and the brokers who miss remortgages, They're not lazy. They just never set up the tracking. Every remortgage they lose is a case that they've already earned once in the past and gave away by not building the system to catch it. Now, the picture at 10 years, let's paint it really clearly because it's what makes the whole conversation worth having. A broker who writes 40 cases a year for 10 years has, in theory, 400 clients. In practice, because some drift, some move away, some genuinely go direct, you may realistically retain maybe 60 to 70% of those in your retention system if it is really decently set up. That's about 200 clients rolling through remortgages every few years. That's 50 to 70 remortgage conversations a year by year 10 from clients you already have without a single piece of new marketing. Add the protection reviews, the referrals that come out of the retention touch points, the family members and colleagues who ask, who did your mortgage over the years? And the book effectively becomes self-generating. And at that stage, the career shifts. You're not hunting anymore, you're servicing. Your income is no longer tied to how many new leads you get this month. It's tied to how well you built the book 5 years ago. That's the promised land of mortgage brokering, and it starts with the boring, unglamorous, invisible work of retention in year one. Once you understand how much real income sits inside remortgages, the next thing to understand is exactly what a broker earns at each stage of their career and how that curve looks from year 1 through to year 10, because remortgages are what bends that curve upwards. But you need to see the whole shape of the plan around it, and that's the video that you should check out next. It's the one on the screen right now. It's what mortgage brokers earn in year 1, year 5, and year 10, and the honest income timeline. Give it a click.